Tax loss harvesting is the practice of selling a security at a loss. Not a very exciting thing to do, is it? But what if I were to tell you that by realizing a loss, you can reduce your tax on capital gains, you can smartly get rid of some of the crappy stocks you might have in your portfolio, and in the process, you can improve your risk adjusted and also tax adjusted portfolio returns. The point is, tax loss harvesting presents a lot of interesting opportunities to investors without any downside. I've been using it for some years now, and with the financial year coming to a close, now is the perfect time to learn and use some of the strategies I'm going to present in this short and sweet video. Let's begin. Actually, before we begin, some announcements. So I recently wrote this gladiator post on my YouTube community page, and I received a lot of good advice and suggestions from many of my Marcus Aurelius type viewers. So thank you so much for that, and I think there were three big ideas which were coming out. One, I should have some participation in current affairs and news topics in addition to my education videos, because that's what the YouTube algorithm is probably looking for. Two, explore videos in Hindi, which is a different audience base and this can be a different channel. And thirdly, I should produce more short format snacky content that people can consume on the go. I'm happy to report that I have started to work on all three suggestions, and anytime now I'll be releasing sub 1 minute videos on YouTube and Instagram. Of course, investing will continue to be the primary theme in these shorts, but I'll certainly want to experiment a bit, including answering a lot of the questions that I'm asked in the comment section of my videos. I sincerely hope this adds more value to your financial life. And now let's begin. So say I bought shares in two companies, Company A and Company B, in August of 2022. The shares of both companies were priced at 100 rupees then, and I had this eternal hope that it would have appreciated by 20% by the time February rolls along. Now, as it stands, we are in February, and I have some good news and bad news. Company A did not do well. In fact, it's not likely to do well for another 6 to 7 quarters, and therefore its stock price is down 30%. On the other hand, Company B had the rub of the green, metaphorically speaking, and is up 30%. Now, here's what people generally tend to do. They would sell Company B at a 30 rupees profit. They would pay the 15% short-term capital gain, and they would continue to hold on to Company A shares in the misplaced hope that a miracle might occur. And that's where tax loss harvesting offers a solution. So to put it in a formal definition, tax loss harvesting is a method to offset the gains from the sale of certain securities against any capital loss and to pay tax only on the net gain. Which means in our scenario, if I were to sell my shares in Company A and Company B, so plus 30 and minus 30 rupees, then it gives me a no profit, no loss scenario. And in the process, I would have reduced my tax outgo from 4.5 rupees in the earlier scenario to 0. This reduction in tax liability on capital gains is our first and primary advantage of using tax loss harvesting. It's a technique that traders use quite a bit. So if they are sitting on some losses in the months of February or March, they religiously use this tax provision to offset these losses against capital gains from their other positions. The second advantage, or might I say a bonus, of using a tax loss harvesting strategy is that it allows me to get rid of useless stocks. So everyone makes mistakes, and if you have a stock portfolio of 15, 20 odd stocks, or even mutual funds for that matter, then you'll likely be regretting some of those 2 or 3 buys that might not have worked well for you. Like in our example, by selling my stocks in Company A, I now have a chance of not only improving my portfolio construct by investing in better stocks, but I'll be able to do this transaction at a notional loss of 25.5% and not 30%. This cleaning up of the portfolio and bringing your asset allocation on track is something every investor should do at least once a year, and I had shared my experience on this in a previous video on building a long-term portfolio. The third technique one can use in the context of tax loss harvesting is the selling and buying back of the same stock. So in our case, Company A's stock was down 30%. But unlike what I said earlier, let's assume this was only a temporary dip and you expect the stock to do very well over the next 6 months. So what one can still do is sell the shares in Company A at 70 rupees, thereby booking a 30% loss. And the very next day, you can buy the shares at 70 rupees to take advantage of the company's revised and improved valuations. Now, my research shows that there is no explicit regulation in India that disallows tax loss harvesting in terms of selling and buying the same stock. The reason I mention this is because in the United States, there are regulations that disallow this type of tax offset wherein the same stock was bought and sold back within 30 days. Nevertheless, it's always advisable to consult your tax advisor or chartered accountant just in case the scenario might lead to a scrutiny by the income tax office. Now, on my part, I have employed all three techniques. That is, I have reduced the taxes I pay on my capital gain. I have used this period to get rid of crappy stocks and improve my portfolio. And I also done sell-buy transactions within the same stock, and thankfully I have not yet attracted the ire of my income tax officer, maybe because I've not done much of it. Now, generally the months of February and March is when I do my tax loss harvesting calculations. And there are a couple of rules, some laws that one must remember. The first one relates to the holding period, and pleasantly tax loss harvesting is available to short-term and long-term capital gains. But the important difference is that long-term capital losses can only be set off against any other long-term gains, while short-term capital losses can be set off against both short-term capital gains and also long-term capital gains. It's an important difference, and I think it gives a lot more flexibility, at least to me, in terms of improving my portfolio quality and post-tax returns. A second point and a related one to remember is the duration of this benefit. And if you cannot use this capital loss in that particular year, then the law allows the investor to carry forward the losses for up to 8 assessment years, which, believe me, can be a very handy proposition. If you're getting good value from this video, then please do give this video a thumbs up. And if you aren't a subscriber yet, then do consider becoming one, as I can then serve you videos as soon as they are released, and also share with you some investing strategies, tips and stories that I continually post in the community section. Now, there's a lot of literature on tax loss harvesting on the internet, articles, blogs, some videos, etc. And if you're using the services of a chartered accountant, then he or she will definitely know the ins and outs of it. But if you're a DIY investor like me, here are some important considerations for you to understand before you implement a tax loss harvesting strategy. Number one, while most investors use the strategy towards the end of the financial year, one can always employ it any time through the year. In fact, it's something even I need to do better to take the maximum advantage of this facility. Number two, the transaction cost of selling and buying a stock should be always kept in mind. To put some numbers around it, and in my opinion, a short-term loss of at least 5% and a long-term loss of at least 10% is the ideal situation to justify the transaction cost and the tax saving involved. Thirdly, and this pertains to that scenario 3 I told you earlier, where one can sell and buy the same stock to take advantage of tax rules. Well, just be careful that you're doing it purely for tax purposes and you're not trying to time the market, because firstly, the transaction costs can really add up. And secondly, and from my experience, the motivation behind investing or redeeming should not have taxes as the core premise. Point 4, and I should have said it earlier, tax loss harvesting is not just limited to stocks, and you can actually use it for many different asset types like mutual funds, gold, real estate, bonds, etc. In fact, there are no asset class restrictions here when you sell and buy something, which means your losses in equities can be set off against gains in debt, real estate or gold, which is a very convenient provision. Point 5, don't go overboard with tax loss harvesting in the sense that don't book excessive capital losses and keep it as a reserve for later. I did this once or twice, maybe thrice, and I realized it was completely unnecessary. And lastly, it's important to know the sequence of how capital gain is being calculated. And one should remember that tax calculations work on a first in, first out basis or a FIFO basis, which means as an investor, you should always understand the tax impact before you start selling some mutual fund units or stocks for the purpose of tax loss harvesting. So these were some broader considerations that I have myself experienced and learned from. And in my view, and as I have said it before, tax loss harvesting does a lot more than just helping me reduce my taxes. If you haven't been doing it yet, then I suggest you pull out a couple of hours this very Sunday and identify opportunities where a misplaced capital loss can be replaced with an overvalued capital gain. And while you do that, your intention and focus should be on correcting your asset allocation and portfolio quality so that your wealth can expand and grow in a well-ordered fashion. If you have any questions, then please write it in the comment section below. And if you yourself are a chartered accountant or a tax advisor, then please take some time to answer some of the viewers' queries. Once again, I thank you for your time. Do like this video, and I'll see you 3 days from now. Until then.